Alright, so we're class 19. Last class we finished up talking about beta. We're going to use beta here pretty soon in the capital asset pricing model to value stocks. But before valuing stocks, I want to talk about valuing bonds. I'll give you a little bit overview, some terminology. You should have had this in 3013, but it'd be a good refresher. And then I'm going to show you some really cool stuff that you can do valuing bonds that you probably didn't get in 3013. So we're going to give you some overview and then definitely get into Treasury bonds first. Treasuries are pretty straightforward. So we're valuing securities. So we're in a whole new section here on page 37 of the notes. We're talking about security valuation. We're only going to talk about valuing stocks and bonds. We're going to start with bonds. But all values of all assets, not just securities, but all assets, the value of an asset is the present value of future cash flows. So we're going to use that with stocks and bonds. It works with real estate. It works with commodities. There can be some exceptions. So if you take gold, for example, gold doesn't produce a cash flow. Obviously, you could invest in a gold company that's producing gold and actually digging for gold, and they have cash flows. But we're talking about gold itself. If you buy a bar of gold, its only cash flow in the future is when you sell it. So it only has one future cash flow, and that's the sales price when you sell it again. So what we refer to securities whose only future cash flow is a sales price of reselling it, that's a speculative security. Very speculative because you don't know what buyers will think in the future because you really have no basis for valuation. Gold's a good example of really no basis. The man who ran USA's precious metal fund, he was the #1 mutual fund manager for 10 years because his gold fund did so well, and gold did really well in the middle of the 2008 crisis. So really smart guy, but you would ask him how much is gold worth and an ounce of gold, and he said, yeah, we don't know. There's no model, there's no way to come up with the value of gold because it doesn't produce cash other than selling it again in the future. But we can value stocks, we can value bonds. What we're going to do is, first of all, forecast those cash flows. For bonds, that's very, very easy because we have a contract and it just tells us, the bond itself tells us what those cash flows are. As long as the bond doesn't default, we know what the cash flows are. Now, we talked about mortgage-backed securities. Mortgage-backed securities are bonds, and they have a very definitive cash flow, but we don't know exactly what the cash flow is going to be because the person borrowing the money can refinance that debt. So those cash flows can really surprise us. We're not going to value mortgage-backed securities in this class, mainly because they're far too complex to value. A typical mortgage-backed security, they will run 100 and something scenarios, maybe 169 scenarios tends to be the normal. And they'll run 169 scenarios of different interest rates environments. And they will assume each one of those has an equal probability of happening, and then the value of a mortgage-backed security is just the present value of all of those different scenarios with 1/69th being applied to each one of them. So there are bonds that we cannot value because the forecast of the cash flow is too complicated. Now stocks we're going to value using the forecast of future cash flows, but with stocks it's going to be a little bit different. You'll see it because it's not contractual. Companies don't have to pay dividends. So it's not contractual, so it's a little bit different math, but that's what it comes down to, is forecasting. What future cash flows will this asset provide? What will the security provide? And then the second most important thing is what discount rate to use. And we're going to use the formula risk-free rate plus the risk premium. For the capital asset pricing model, our risk premium is beta times the market risk premium. So for stocks, we're going to use the risk-free rate plus beta times the market risk premium. We still have to talk about the risk-free rate and the market risk premium for stocks. With bonds, these are both really straightforward, as you'll see today. So let's start with bonds. So we had a 5-step process earlier in the class. All of finance, for the most part, can be summed up in forecast cash flows, determine a discount rate, get the present value of those cash flows using that discount rate, sum that up, and that gives you the intrinsic value, what you think the asset's worth. You compare that to what the current market value is, and you make a decision. So that first step was forecast the cash flows. With bonds, piece of cake for most bonds. Notice I say non-amortizing, non-callable bonds. Very, very straightforward. We have the face value, which is how much you get at maturity. That's also known as the par value, also known as the maturity value. We have the coupon, so the coupon times the face value, the coupon times the par value, the coupon times the maturity value, or by the principal. There's several terms there. We have 4 terms that mean the same thing. That coupon times that principal, that's how much money you get every year. But with bonds, we're going to assume we get the cash every 6 months. Most bonds, Treasury bonds, corporate bonds, pay interest every 6 months. So we're just going to do that. And that cash flow is very straightforward. It's just the coupon times the principal of the bond divided by 2 because we pay twice a year. You'll see that as we walk through some examples. So we're going to value treasuries and corporate bonds, but the corporate bonds we're going to value are going to be non-callable. We're not going to deal with the complexity of a callable bond. We're definitely not going to do amortizing bonds like mortgages. Mortgage-backed securities is far too complex. The second thing we have to do is determine the discount rate. Well, for a bond, it's the same thing with any other asset. It's the risk-free rate plus a risk-free rate plus a risk premium. For bonds, we refer to that risk premium as the spread. We talked about spreads before on exam 1. You talk about spreads widening and narrowing. Lower quality bonds have wider spreads. High quality bonds have narrower spreads. Treasuries, by definition, have no spread because they are the risk-free asset. So they just give you the risk-free rate. So the risk-free rate we're going to use is the treasury with the same maturity as the bond we're valuing. So if you're looking at a 5-year corporate, we'll use the 5-year treasury. If you're looking at a 10-year treasury, you'll use the 10-year treasury. We're using actual current yields, so the price we're coming up with is the market price, not necessarily our intrinsic value. But I'll talk a little bit about how the difference in intrinsic value versus market value would work. We're actually going to be taking market values, market yields, market spreads, the value, what we think the bond's actually being priced at today, what we could buy it for today, not necessarily what we think it's worth today. Corporate spreads, I'm going to show you a table to get the corporate spreads, and they're going to reflect the default risk of the bond and the recovery rate on the bonds. So I'll show you some tables on that. In fact, let me just show you one now. This one's only related to the ratings and defaults. So it shows you, oh, I love this table too. I would actually take this table, I would print this out and put it in your wallet. I just love this table. It's a little dated. It's about 10 years old. I just haven't found anyone that will update this table any more recently. I should keep looking. It says it's Capital IQ, so maybe it's out there on Capital IQ. If I can find a more recent one, I'll update it. But the numbers aren't radically different today. This is after the 2008 crisis, so even though it's 10 years old, we haven't had that much happen in the last several years. But essentially what they do is say what percentage of AAA bonds default within 1 year. And the percent is 0%. And you see as you go over time, the percents come up, but they don't come up much. Over 10 years, less than 1% of AAA bonds default over 10 years. Just very, very rare for AAA to default. So those are really high quality bonds. As you go to AA, you can see slightly higher probabilities, not radically so. In some years they're exactly the same, but slightly higher probability of default over 10 years, not much. You get the single A, there's appreciably higher. You can see a big jump between AA and single A. And then when you go from single A to triple B, you see a huge jump. So about 5%, and this is something good to memorize, about 5% of triple B bonds default over 10 years. Then when you get down and below investment grade, look at the huge jumps down here. So triple C bonds, over half of them will default in the next 10 years. And in fact, over a fourth of them will default in the next year. So yeah, very, very risky. So investment grade bonds, that's your triple B, single A, double A, and triple A. On average, about 2.5% of them default in 10 years. The speculative, the double B, single B, and triple C, about 25% of them default. And about 10% of bonds overall default. But if you only buy investment grade, then you only see about 2.5% default. Now this is just default. You also have recovery. So even though a firm like Enron defaults, that doesn't mean the bondholders get zero. They get to sell the assets and get as much money back as they can. So higher quality bonds like AAA and AA and single A, recovery rates are usually about 50%. So even when they default, you'll still get about half of your money back. As you get down to lower quality bonds, the recovery rates get more like 40%. So in my risk management class, we talk about this. There's actually a math problem on, I think, the second exam, might be the first exam, I can't remember, but asks us how much spread should the bond have if these are the default rates and we know what the recovery rates are. So let's think about that for AAA. So you have 0.78% default over 10 years. Well, you take that 0.78 and divide it by 10, then on average, you would lose about 8 basis points a year. So let's round this 70 up at the 80. 80 divided by 10 is 8, so 8 basis points. So you'd expect to lose about 8 basis points a year, but that's just default. But you'll get about half of your money back because of recoveries. So really, AAA bonds, you only need about 4 basis points in spread to on average cover you. They pay a lot higher than 4 basis points, but all you would really need is about 4 basis points. For BBB bonds, about, let's say, 5% default over 10 years, so that's 500 basis points. 500 basis points divided by 10 is 50. So you'd have about, on average, you'd have about 50 basis points default every year on average. It kind of jumps around, but about 50 basis points a year. If your recovery rate's about 40%, then you have 50 basis points times 0.6, so about 30 basis points is what you would need on average every year in spread. But BBB bonds pay a whole lot higher than 30 basis points, and that's one thing you'll notice with corporate bonds. They tend to pay you a whole lot more than needed to cover average defaults and average recovery rates, or 1 minus the recovery rate. So this is a great table. If I can find a more updated one, I'll bring it in. So that was step 2, is you look at your risk-free rate plus the spread, your discount rate. Step 3, just get the discounted value. That's what we're going to be doing today with Treasuries. This gives you the intrinsic value, or in our case, we're actually going to be calculating out what we think the market value is. But again, I'll show you how we can do the intrinsic value. Compare the intrinsic value to the current market price. So you think the bond should be trading at 102. It's actually trading at 98. So you buy it at 98, you think it's worth 102. It's unlikely you'll find a bond quite that good, but it's possible. In 2008, there were bonds trading at 20 cents on the dollar that people thought were worth 100. And I remember some of the fixed income managers and analysts at UTSA, they wanted to pull all our money together and just buy millions of dollars of those things. And they just couldn't get it worked out fast enough, but they did. Those things were up just tremendous amounts in 2009. It was a good buy. You would have made much more money on those than you made in the stock market. It was just pretty incredible. So then you make a decision: do you buy, hold, sell, short, or ignore? Bonds, you can short bonds. Sell means you own the bond and you decide, hey, my intrinsic value is higher than the current market value, so I'm going to sell it. Buy is you don't own it, so you buy it. Hold is you own it, and the valuation looks good, not particularly great, not bad, so you just say, I'll just hold on to it. Sell is you own it and you don't like the intrinsic value versus the market price, so you sell it. Short is you don't own it, but you short it hoping the price will fall. You can do that with bonds. It's not that difficult. I've actually shorted Treasury bonds before. It's not that difficult to do. Or you just ignore it. Don't do anything. It looks like it's well valued. There's no opportunity there. You don't own it. You don't want to buy it. So that 5-step process applies to all assets. With bonds, the unique thing with bonds is that the forecast of the cash flow is very straightforward. So again, let's just get these key terms again. Face value, principal, par value, maturity value. That's how much you get back at the end. So we're going to assume that's $1,000 just to keep things easy. The next term is coupon. The coupon is stated in the bond. It's part of the contract of the bond. And you get essentially the coupon once a year, every year, but you can get it in 2 pieces. So what we do every 6 months is we get the face of the bond times the coupon divided by 2. We'll be practicing that here real shortly. The current yield, anytime you see the word yield, think about some kind of current income divided by a current price. So the current yield is the coupon today divided by the current price of the bond today. So current yield is your 12 months of income divided by whatever the price is today. Remember, when yields rise, that means prices have fallen, so the coupon doesn't change. The 12 months income is the coupon. That doesn't change when yields go up and down. That's the same because that's stated in the bond. But as prices rise, you take that fixed amount of income and divide it by a higher price, it's going to affect the yield. One way as the price falls, you'll get higher yield. So that's the current yield. I mean, that's the nice thing about the price of a bond's falling, is that your yield goes up. So if you wait until interest rates rise, which means bond prices are falling, then you're going to get a higher return if you're right. If you wait and yields actually fall, that means the current price is higher, then you're going to be wrong to have waited. We have something called yield to maturity. We talked about that earlier. That's essentially the internal rate of return on the bond, the IRR on the bond. It's the discount rate that gives you the current price of the bond, such that if you take the present value of all the cash flows in the bonds, you get the current price. We'll talk about the effective yield. The effective yield is essentially taking that current yield and adjusting for the fact that bonds pay every 6 months. So you have 2 payments a year. So we take the current yield, divide by 2, and raise it to the second. Essentially, we're compounding that coupon twice a year. Because if you get the coupon, you get to reinvest it. And so we're essentially giving you credit for that. So you'll see why that's important here. That's going to be our actual discount rate. We're going to use the effective yield. This effective yield is the same thing you've probably seen with CDs, that they talk about an APY, an annual percentage yield. So certificates of deposit often pay interest 12 times a year. So if you pay interest 12 times a year, you would take the current yield, or you take the yield expressed on the CD, divide by 12, and raise it to the 12th power. So the APY is the yield you get if you leave the interest in the CD and you let it compound with the CD. And APY will always be higher than the actual stated yield, because they're assuming you're compounding every month or whatever period you're using. So it's a very similar concept, except for how many times you get income. So if you get income once a month, then you divide by 12, raise it to the 12th. With corporate bonds and treasuries, we only get income twice a month, so we divide by 2 and raise it to the second. And I'm going to be doing this, so don't panic if that's not making sense. You'll see it when we work through it. So bonds, if their coupon equals the current yield, then it's going to be priced at par. A bond that matures at $1,000 will cost you $1,000 a day. If the coupon is higher than current yield, this is a great bond. It's paying you 6% in a market where bonds are only paying 2%. That's going to be a premium bond. You're going to really love that bond. Most of the bonds we're going to price are going to be premium bonds, just because they were issued years ago and interest rates were much higher. So the coupons are much higher and interest rates have come down. So it's hard for me to give you this third one where the coupon is less than the yield to maturity. Right now, interest rates are just all-time lows. There are not many discount bonds up there, but your coupon's 2% and you're in a market that's paying 6%. Yeah, in that case, this might be a bond that was downgraded. Maybe it was paying a coupon of 6%, but it's been downgraded to single B. So now its yields much higher. That could be a discount bond, and that means you're going to buy it for less. It's going to mature at $1,000, but you get to pay less than $1,000 because you can get a better yield somewhere else. So they've got to induce you to buy this bond by giving you a lower price. We've already seen these two formulas. Remember, the percentage change in a bond can be approximated as minus duration times the change in yield. If you have convexity, remember you can adjust it for a convexity as well. Some of y'all probably put that on the first exam answer when you're talking about convexity. We're not going to use, for our purposes, we're not going to use this last formula because I don't have convexity on these bonds, but we will use this first formula, and I'll show you how you can use this first formula so that you can approximate your bond price before you actually do the detailed calculation. That way you know, you have a lot of confidence you have the right answer. So let's just get into this and start pricing bonds. All right, so I'm going to do this in Excel. On the final exam, you may actually be doing this in Excel. So I would learn this in Excel. I'll be able to do it both ways. Now let me just tell you right now about calculators. You can obviously do this in a calculator. If you have an HP calculator, it will do these calculations. I don't care if you know how to use an HP calculator, because once you graduate, you may never touch that calculator ever again the rest of your life. I remember once I needed to run to a meeting. This is before we had calculators on our iPhones and on our smartphones. I need to run to a meeting. I wanted to get a calculator, and I didn't have one. I didn't use a calculator in so long. We always use Excel or whatever software we're using. So I had to go to one of my peers and say, hey, you have a calculator you can loan me? And open his drawer, had a calculator sitting there. He had to blow the dust off of it because it had been sitting there for so long. It still worked. It had a solar kind of panel to keep the power going. It worked. But yeah, we just don't use calculators much. So I don't care if you know how to use a calculator. You're certainly welcome to use a calculator to check your work, but I want to see all of your work. I want to make sure you understand exactly how bonds work. One thing that really bothers me is when I see a finance student enter a bond into a calculator and get an answer that is obviously wrong. They miskeyed something. They meant to key 6% and accidentally keyed 60%. It's an obviously wrong answer, and it doesn't faze them a bit. They don't have any clue that it's a wrong answer. That really bothers me. So make sure you're understanding what the math is actually doing. The key in finance is to know what formulas you're doing. What is the actual underlying calculation? So we're going to do a Treasury bond to get started. And let's do a 10-year bond. It's actually a 20-year bond issued 10 years ago. So all we care about is how much time is left. So if it's a 20-year bond issued 10 years ago, I'll put it up here, 20-year bond issued 10 years ago. Yeah, it's a 10-year bond. All we care about is how much time is left, not how much when it's issued. Now, what's the 20-year bond going to do for us? Well, because it was issued 10 years ago as a 20-year bond, it's going to have a coupon that's real close to what interest rates were 10 years ago. And so that's going to be pretty different than today, to be sure. Let me get that yield so we can actually see what it is. See, 10 years ago would be October 2011. So let's go back to 2011, just see what interest rates were back then on 20-year bonds. And yeah, about 4.5%. So let's do that. Coupon is 4.5%. So that's interesting. That probably seems like a ridiculous rate to you. That seems pretty normal to me. We're getting so used to these low rates. So today, that same bond that had a 4.5 coupon back then has a current yield. Well, let me give you some ideas. You can pick which one. Let's look at a 10-year bond and a 20-year bond. So a 10-year bond has a current yield right now. This is a couple of days old. I don't have actually today's. 0.0079 or 0.79%. And a 20-year bond has a coupon of 1.34%. So the question is, remember that the discount rate is going to equal the risk-free rate plus a spread. So here, what's our risk-free rate? Well, we can't use the 20-year rate because it's not a 20-year bond anymore. It's a 10-year bond. So we're going to use a 10-year yield. And our spread, so 0.0079, our spread is 0 because it's the Treasury. It's risk-free. So our current yield is going to be 0.0079%. I'm sorry, 0.79%. 0.0079 or 0.079%. So yeah, make sure you have that. Remember, Well, here I'll give it to you as percents. Spreads we give you in basis points. So you'll have to know when we do corporate bonds, you have to know how to do that. All right, let me mark this as a Treasury. I'll say Treasury 1 because we might do another one. All right, there's our current yield. Now what we want to do is the effective yield. So remember the effective yield is 1 plus the current yield divided by 2 raised to the second minus 1. It will always be higher than the current yield. So we'll do 1 plus 0.0079 divided by 2 raised to the second minus 1. So it's probably going to be like 80 or something. Well, here it hardly increased at all, but it increased a little bit because we're such a low number. If this had been 5%, the difference would have been much more noticeable, but at 0.79% it's not as noticeable. All right, so what else can we do with this? All right, so I'm going to give you 3 approaches for this problem. The first one is the estimate using duration. All right, we're going to try that approach. The second one is the discount table. This one's required. You must do this one. And the last one is the formula. All right. And if you want to, you can definitely use your financial calculator. I won't be doing that. I'm sitting here on Excel. Why would I touch a calculator? So I won't do that. It would take me a couple minutes to remember what buttons to push because I haven't done it in a while. But I would actually probably enter it with the formula versus using the financial calculator's functions. So those are the 3 approaches. Let's start with this first one. I like this first one. Now we're talking about a 10-year Treasury here with a very, very low current yield. We'll get its actual duration. On the exam, I'm probably going to, well, we'll see. If we're going to do the exam on Excel, there's no telling what I could do. There's some things I could do get much more advanced. But I usually give a 2-year bond. A 10-year bond's duration can range anywhere from 7 to 9.5 years. I'm going to guess the duration is, I'm going to say 9.2 years. Let's see how close I am. Boy, it's maybe way off. I'm going to guess that. And we know that the percentage change in a bond price is about minus duration times the change in yields. Well, let's think about this bond. When this bond was issued, it had a coupon of 4.5%, which that means that's what the yield was back then. So it used to be 4.5%. Now the yield is 0.79%. So let's think about the change in this price. So if our duration is 9.2, we do minus duration, 9.2, times and change in yield. What did yields do? Well, today they're 0.0079. 10 years ago they were 0.045. That's going to give us what we think this bond price is going to be. So it's going to be much higher today, but how much higher? So let's actually do the math. Minus 9.2 times 0.0079 minus 0.045. And we think that bond price should be 34% higher. So what's my guess on the price? Well, it's going to be $1,000 times 1 plus 0.3413. My guess is this bond's going to be trading somewhere around $1,341. All right. So that's one way you can do it. The change in yield is just the difference between your coupon and the current yield. You take the current yield minus the coupon. Shows you that interest rates have fallen quite a bit, so the price should be up. And we just use the formula. One reason I like this approach is it gets you to use this formula somewhere, and it's a really famous formula in finance. So, boy, you should just know it. If you interview for a job, they will assume you know this formula because it's used so much. All right, let me give you the formula approach. Now, the formula approach is, boy, I always do it wrong the first time, but there's something called a perpetual annuity. And a perpetual annuity says an infinite cash flows value equals the cash flow divided by the discount rate. We're going to use this formula when we value stocks. So this bond doesn't have an infinite cash flow, but let's assume that the coupon were infinite. How much would an infinite coupon be worth? Well, that's going to be the coupon divided by the discount rate, or the yield actually in this case. Well, in this case we're not getting a coupon once a year, we're getting it twice a year. So in this case, what is the coupon? So the coupon on this bond, this coupon up here is the coupon yield, but we want the coupon in dollars. So what's the coupon in dollars? It's going to be 4.5% times $1,000 divided by 2. So we get that every 6 months. There's our cash flow. It's $22.50 every 2 months. So here's the value of that $22.50, if we got it forever and ever and ever, would be $22.50 divided by our current yield is 0.0079. We have to divide by 2 because we're getting it twice a year. So there's the value of our coupon for all of eternity. So $22.50 divided by 0.0079 divided by 2. But we're not going to get that coupon for all of eternity. Okay, so what we have to do, we need to add the face amount and eliminate coupons after year 10. All right, we did coupons for all of eternity, but we need to add the face amount and eliminate coupons. So how do we do that? Well, it's $1,000 minus the exact same formula, $22.50 divided by 0.0079 divided by 2. We'll get a huge negative number there, but that's in future value terms. And so what we want to do is take all of that and discount it to the day. So we're going to divide that by 0.1 plus 0.0079 divided by 2 raised to the 20th, not because it's 20 years, it's 10 years, but there's 20 payments. And oh, Bill Gates doesn't like my parentheses for some reason. I don't know why he doesn't like my parentheses. As I told you, I never get this right. It's always a parentheses problem in doing this. So 1,000, probably have too many parentheses there. No, I need a parentheses there. 1 plus that raised to that. Ah, here's where I needed one more parentheses there. There we go. All right. All right, so if I do that, then we get the value of the bond going to be equal to the value of the infinite cash flow plus the face value minus the infinite cash flow after year 10. And we get 1356.05. That looks like that's pretty close because my guess figure was 1341. So if you look at this formula, this entire formula, the actual formula, it should look familiar to you. So we take the cash flow divided by the current yield divided by 2. That's the cash flow for all of eternity. We take that plus the face, $1,000, minus, let me put a parentheses in here, minus the cash flow divided by the current yield divided by 2. This first formula all over again. We're going to take all of this, that's where I'm getting my parentheses issues, and we're going to divide that by 1 plus the current yield divided by 2 raised to the n. I need some more parentheses in here, so let's just get that. So we'll close this one down. So I don't know if I got the parentheses right. I got 1 there, 1 there, 1 there, 1 there, 1 there, 1 there. So the numerator is okay. The denominator is okay. We might put 1 more in there just to make sure. I don't like the one I just did. Let me do a bracket. So anyway, so there's the formula. If you look at this formula, you should go to your present value interest factor of an annuity. And if you look at that formula, take the $1,000 out, because a present value interest factor annuity doesn't have, you know, suddenly $1,000. It assumes the same cash flow for 10 years without the $10,000 coming in. This formula looks exactly like that formula if you were to actually do it. It's the exact same formula. So we're adding this, but we're actually subtracting this back out. So if you took the $1,000 out, trust me, go to your it's probably in your accounting textbook. If you go look at that formula, you will see this. And something you might do is take the divide by 2's out, because you just assume that you have those. But anyway, that's the nature, and you can actually simplify this so it will look exactly like the formula that you see in your college textbooks. But anyway, that's the formula approach. So what I want to do is do the discount table approach. So you might do the formula approach second if you do it at all. The formula approach is what your calculator is doing, so just be aware of that. So now we're going to do the discount table approach. If you've had me before, like in 3013, this is what we did. So what we're going to do is we're going to look at time, we're going to look at the cash flow, we're going to have a discount factor, and we're going to have a discounted cash flow. Now we'll do more with this than just this, and I'm going to show you what else you can do. But so time is, we're going to do it from today. So we're going to assume our first cash flow comes in 6 months, which is half a year. Then we're going to add 6 months onto that. So we're going to have half a year, 1 year, 1.5 years, 2 years. So I just take the, I start off with 0.5, and then I just take that 0.5 and add 0.5. We need to go out 10 years, so that's going to be 20 cash flows. So we have 10 years of cash flows. What is our cash flow? Remember, our cash flow is $1,000 times 0.045, which is our coupon, divided by 2, or that $22.50. That's our cash flow every year, except for every 6 months, except for when at the very end. At the very end, we get our $1,000 back. Remember, I said assume a face amount of $1,000. And then what is our discount factor? Where our discount factor, we're going to use the effective yield. So for the discount factor, we're just going to use the formula 1 divided by 1 plus the effective yield raised to the time. That's the formula we're going to use. So 1 divided by 1 plus our effective yield. We need to hit the F4 key, or the function 4 key if you're on Mac. Close parentheses, raise at the time, where here's our time right over here, 0.5. So how much? What's the value of $22.50 if we're going to receive it in 6 months and our discount rate is 0.792%? The value of that discount factor is going to be 0.9961. So the cash flow we just multiply across. So the present value is 22.41. I'll do that as dollars. All right, so there's my effective yield. 1 divided by 2 open parentheses, 1 plus, and go up to your effective yield. Lock that in. Raise it to the time, the 0.5. Make sure you have your parentheses in the right place. You should get a number that's 0.99 something on that very first 6 months. It shouldn't be much higher than, it shouldn't be much different than that. Then you copy that down. You make sure each one's getting lower because the present value is getting lower all the way down to the very end. And then you just do the same thing with each one of these. You just multiply across. So you notice each cash flow's present value is a little bit smaller each time. And so then we get the price of this bond. It's just going to be the sum of the DCFs. So we just do equal sum. We just add all these up. We get 1356.05, which is exactly what we got up here with the formula. Let me show you the formula again all together. So we're going to do equal 2250 divided by here in the formula use the current yield, not the effective yield, because that divide by 2 is taking care of that. We're then going to add $1,000 minus, and we'll put all that in again, B19 divided by B4 divided by 2, and take all of that and then one more parentheses, and divide that by 1 plus, again, our current yield divided by 2, raised to the 20th, not because it's 20 years, because it's 10 years, but we get coupons every 6 months. And that gives you the exact same, I mean, it's exactly the same. All right, so we get the exact same answer using the formula and using the table. On the exam, you're required to do the table. I want to do one last little check here, and that is the longer formula. Remember, the longer formula says minus duration times the change in yield plus convexity times the change in yield squared divided by 2. I don't know if y'all remember that formula. Some of y'all probably put it on the first exam. So we got to get convexity, and so let's go over to this spreadsheet. This is a spreadsheet I have out there on Blackboard, and I put the bond in here. It's a 10-year bond, 4.5% coupon, and yield of 0.79%. There's my duration. This is actually the modified duration, so it's a little bit lower than what we had. But there's our price. Everything in here is the same. So, so we can. There's the formula right there. So I'm going to take these two numbers over there and paste them. So there's my duration and my convexity. And so I'm going to take minus duration times the change in yield. The change in yield is 0.045 minus 0.0079 minus 0.045 plus convexity times 0.0079 minus 0.05, the change in yield, square that, and divide by 2. And when I do that, I get a price appreciation of 37.28. So that means take $1,000 times 1 plus that. That means with convexity, we get a price estimate of $1372.84. Higher than what we got, but much better than using duration alone. With duration alone, our answer was off by 3%. When we use convexity and look at how far off we are, we're only off by 1.24%. So convexity got us closer. I'm not asking you to calculate convexity on the exam, that's for sure. You don't even have to calculate duration. But because there's really, the convexity formula is quite messy. but it does get us closer. It gets us in the ballpark. It went a little bit too high, but it got us closer there. So, and these formulas are great formulas. Not many undergraduate students. Well, if you get in an interview, they're gonna assume you know this first part of this formula: minus duration times the change in yield. I don't know what percentage of undergraduate finance students know that. I bet it's a much worse percentage than I would think. Maybe even fewer than half. I bet fewer than 5% know that full formula from memory. I have to look it up sometimes, though I haven't looked at it in a while because I always forget where the parentheses go. But it gives you a little bit more accurate number. So, all right, so there's our first Treasury. What I want to do now is walk through a second Treasury without all the distractions I just did. So now what we'll do is we're going to price a bond. I'm going to say that it's a 20-year Treasury issued 15 years ago. Actually, I'm going to do a 30-year Treasury issued 25 years ago. So what is this bond? It is a 5-year Treasury. That's what it is. So let's look at some current yields. Let's look at the 5-year. And let's look at the 30-year. Today. So the 5-year Treasury today. Sorry, it's hard for me to see this other screen, but the 5-year Treasury today let me see, 5-year Treasury today is 0.0034%, and 30-year today is 1.58%. Still an amazing number. Current yield. So what is our current yield? Well, it's a 5-year Treasury, so our current yield is 0.34%. So on the exam, if I give you a 30-year bond and give you current yields for a 5-year Treasury and a 30-year Treasury, make sure you use the one that's how much time is left. All right, let's get the coupon. All right, 25 years ago is, y'all weren't alive then, but I was still working at UTSA back then. In fact, I had another 15 years ago in my career. I'm not sure I can go back that far. Yeah, I can actually. 1995. Be scary to think what yields were back in 1995. Oh my word. Crazy stuff, crazy stuff. All right, so yields were actually 6% back then. So that means the coupon would have been about 6%. Now, at the beginning of the year, 1995, actually is a very famous year, now that I think about it. In 94, that's the year that Orange County went bankrupt because the Fed raised rates the fastest they've had in a long, long time. Greenspan got really nervous about inflation, so he just shot up interest rates really fast. So they rose really fast, and then in 95 they dropped really fast. So at the beginning of 95, believe it or not, 5-year yields were 8% at the beginning of that year, but by October they had dropped back down to 6%. So pretty crazy 94, 95. They're actually very famous years in the bond market history. All right, so then we got to do an effective yield. Remember the effective yield, we do 1 plus the current yield divided by 2 raised to the second minus 1. It's going to be almost exactly the same. Just adds a tiny bit on the end. All right, so what are we going to do? Our first thing we're going to do is the guess. I'm going to guess that the duration for this bond is probably about 4.5 years. So remember, we're going to use the formula minus duration times the change in yields. And that's going to give us a percentage change in this bond. So we do minus duration times, and our yields went from, or today, 0.0034. They were 0.06. So I think this bond should be trading at a premium of 25%. So I'll take $1,000 times 1 plus that. So my guess on this bond is that it should be trading for $12.5470. Let me do the long formula that I always get wrong every time I try it the first time. So again, what is my coupon? So let's get the coupon. in dollars. This is the coupon in percents. So the coupon in dollars, again, we take $1,000 times the coupon divided by 2. So we're going to get $30 every 6 months, or twice a year. So let's try the long formula. Remember, the long formula is the coupon divided by the current yield, not the effective yield, the current yield, 0.0034 divided by 2. We're going to add to that the maturity value, but we're going to subtract out the 30 divided by 0.0034 divided by 2. We're going to subtract that out. We're going to take all of that and divide it by 1 plus 0.0034 divided by 2. And we're going to raise that to the n. The n is not 5, it's 5 years, but we're going to raise it to 10 because you get cash flows every 6 months. And there's the actual number. That looks pretty good to me. That's probably the right number. But the last thing we'll do is the discount table. It's the one that's required. So there we got time, we got cash flow, we've got the discount factor, we got the discounted cash flow. So we'll put all those in there. Time, we'll start half a year. Then we'll add a half year to each one of those and go out 10 periods or 5 years. So again, our cash flow is $1,000 times 0.06 divided by 2. Our cash flow is $1,000 times 0.06 divided by 2. At the very end, we get our $1,000 back. So we put that down. Our discount factor, again, is 1 divided by 1 plus our effective yield. Raise the time, and you should get something slightly below 1. Go out 4 decimal places. Just the standard. If you look in your accounting textbooks, you'll notice they go out 4 decimal places. So then just multiply across. So $30 6 months from now, when the discount rate's only 0.34%, it's worth only 5 cents less than $30. Essentially the same. And so that gives me a price. So here's the formula. Here's the table. The table, we just take a sum of those discounted cash flows. We get 1280.37. That worked. I'm going to do one last time. I'm going to try the duration calc. Again, very simple. You just take time times each cash flow divided by the total cash flows. So you get discounted time to maturity. And so my actual duration, Macaulay duration, see how close my 4.5 was. It's 4.48, so I was kind of in the ballpark there. So you can see my estimate was pretty good. I'm only off, well, be closer than I was when it was a 10-year bond. I'm only off about 2%. I was off 3% on the previous one. If I brought convexity in there, it might be even closer. All right, so there's how you do it. The table is the only thing that's required. You have to do this. You don't have to do the duration calc, and you got to give me the price. That's what required. But I recommend you do everything else. I recommend you do the estimate. First, it gives you more confidence you got the right answer, but it also shows you know how to use this formula. You can't use the longer formula with convexity because there's no way you're going to calculate convexity with what you have to work with. I'm not recommending any of y'all learn that formula. You could do it if you want to learn the formula, but it's, and I'm not talking about this formula, minus duration times the change in yield plus convexity times the change in yield squared divided by 2. I'm talking the formula that actually gives you the convexity number. That would be a little bit much. And then I would do the formula too, because that formula tells you exactly what your calculator is doing. Wouldn't it be nice when you plug stuff into a calculator, you know exactly what the calculator is doing. But anyway, that gives us good practice. And so what we'll do next class is we'll calculate the value of a corporate bond. We'll do a few examples of corporate bonds. So we'll get more practice. The only thing we have to do with the corporate bond is bring the spread into it. And we'll talk about the term structure of corporate spreads in that next class. But once we get the corporate spread in there, we just add it to the risk-free rate. Everything else is exactly the same. there's really nothing else for us to do. And I'll try to get you at least one discount bond if I remember next class. Maybe I'll have a bond that's downgraded, so we'll have to bring credit ratings in. There's a few more things I have to do with corporate bonds, but it's not that much different. All right, so I hope all that makes sense. I will not give you this spreadsheet. Try to build it yourself. If you try it and you can't get it to work, then email me what you do, and I'll show you where your problems are. All right, thanks.